central bank reports that have mentioned Bitcoin. So the ECB had a report saying that basically if Bitcoin goes up a lot, then it benefits the holders and it punishes the non-holders or the late adopters. But that's true for any asset. I mean, when U.S. tech stocks added, 10 trillion in market cap over a decade, you want to be owning those. You didn't want to be the one not owning those. Same thing if Bitcoin goes up at size. So it's like, they argued before that Bitcoin's done is a bad investment. And then now they're shifting it to, if it's a good investment, then that's also bad because it means that those that don't own it are missing out. And that we should maybe curtail that. We should get all the non-Bitcoiners to help us in our politics against Bitcoiners, essentially.
Welcome back. Today we're diving into Lyn Alden's unique insights on Bitcoin and its remarkable correlation with global liquidity. Over the course of a year, Bitcoin has demonstrated an amazing tendency to move in tandem with liquidity around 83% of the time. Bitcoin is particularly sensitive to changes in liquidity conditions because of this, which offers it a distinct advantage over more conventional assets like gold and stocks. In contrast to bonds, which are less closely linked to liquidity, Bitcoin's performance demonstrates its status as a dynamic asset in the current financial environment. Alden notes, meanwhile, that Bitcoin doesn't always match liquidity trends exactly. The price of Bitcoin may change in roughly 17% of instances, frequently when its market valuation begins at a very high level. As we continue to explore Alden's perspectives on Bitcoin, liquidity, and the overall market environment, don't forget to like the video, subscribe to the channel, and hit the notification bell for more deep dives into cryptocurrency and macro trends. Leave your thoughts in the comments below, and let's hear her following words.
Bitcoin was the highest on the list. It was the most directionally correlated with liquidity. So in any given 12-month period, Bitcoin would move in the direction of global liquidity 83% of the time, which is higher than other assets. Gold and stocks were also very high, whereas like bonds were pretty low correlation. And then we did other studies to say, well, if Bitcoin's only correlated with liquidity 83% of the time, what's happening the other 17% of the time? What are the other major drivers? And one of them was valuation. So one of the biggest catalysts for what can give you a 12-month period where Bitcoin goes in the opposite direction of liquidity tends to be when it's starting from a very high valuation. And we measured that in terms of market value to realized value, which is kind of on-chain cost basis. So when you have a really big bull run, the market value goes up a lot, but it's not necessarily a ton of coins trading hands. There's not necessarily a lot of volume locked in at those higher price levels. It's kind of like if you have a street with 20 houses on it and one of them sells for $50,000 more than it sold last year. All the houses on that street go up in estimated price, even though really only 5% of them traded hands, one out of 20. And the same thing happens to a less extreme scale with Bitcoin, that when you have a really big bull run, there's a fairly small amount of volume that's making the value of all coins higher. But some of that is kind of ephemeral. And then over time, generally speaking, you get a weakening of the market cap and you get a steadily increasing of the kind of the cost basis as more and more coins trade hands. And so generally buying in periods where you have that really big dislocation increases your odds of having a negative year despite positive liquidity. So by looking at both liquidity conditions and looking at relative valuations, that can generally help entities, have a reasonable view of what might happen over a given 12 to 24 month period with the asset. The deficits in the US are likely to continue chopping along. There's even a case that they could narrow a little bit next year because there's some tax cuts that are set to expire, and it depends on the election outcome and the congressional structure at the time to see how that resolves. But either way, they're not going to shrink dramatically, but they're either, they're going to chop around. And so there's this background deficits that are happening. Two is that we're probably going to get to the end of quantitative tightening next year. By the Fed and certain other central banks. And it's not going to be because necessarily they want to stimulate, but it's going to be similar to September 2019, where there's some little liquidity pocket and they have to go back to maintaining that ample floor of bank reserve liquidity. Unless they want to do things like change the SLR rules or things like that, but that's also a form of liquidity easing. So they're going to have to, I think, pull a couple levers by the end of next year, and that probably means stopping quantitative tightening. Even if you look at the annual report that the Fed put out earlier this year, they even predicted that by the end of 2025, they'll probably go back to the end of quantitative tightening. And they describe it as like they chart out their expectations of keeping their balance sheet at a similar percentage of nominal GDP. So as GDP goes up, their central bank balance sheet goes up, and they're gradually monetizing some of the deficit, even though they wouldn't use that term. And it's not for the purpose of stimulus, but it's the purpose of not having bank reserves shrink relative to bank assets and relative to the size of everything else. So I do think that, by the end of the next year, we'll have that going on, which is a pro-liquidity move, and you could see that from other central banks. And then I think that there are pockets of the U.S. economy that are slowing, and rate cuts are not very effective at addressing those for a couple of reasons. One is that so much debt is already locked in at lower rates anyway. So unless you're willing to cut all the way to zero, which I don't think is going to happen, it doesn't really encourage a lot of new refinancing and things like that. And two, as you pointed out, that sometimes when you cut the short end, the long end doesn't go down or it goes up. And that's actually what a lot of people are borrowing at, is the longer end. And so I think that I don't really expect an explosive 2025. I think liquidity conditions are not like this big vertical liquidity party. But I do think that 2022 is a particularly bad year for liquidity. That was an awful year for liquidity. It stabilized in 2023 and 2024, gradually inching back up. And I think that 2025 is either continuing to gradually inch up or could inflect a little bit more quickly up. But I wouldn't necessarily expect fireworks. The other big variable to watch is China. It's not just the U.S. So China is another big variable. They have recently turned toward mild stimulus in terms of the value of the stimulus that they're doing. But I think it's an important signal that they're kind of drawing a red line under their current economy. So they're not necessarily trying to juice it up, pump the property bubble again, but they're slowing down the rate of deleveraging that's happening. And I think that's a pretty big turning point for impacts on liquidity. So I think you have a couple different variables coming together that may not give you an amazing liquidity environment. It might not be like 2017 or 2021, but I think it's better than 2022 is awful, and I think it'll be equal or better than 2023 and 2024.
Lyn Alden highlights recent central bank reports that address the possible effects of Bitcoin on the distribution of wealth. The European Central Bank, ECB, for instance, pointed out that early adopters gain a lot from Bitcoin's rising value, while late adopters or non-holders can feel left out. Although this is true for any asset that gains value, the ECB's remarks show a change in viewpoint from considering Bitcoin to be unimportant to acknowledging its increasing financial power. Alden points out that governments typically support a financial system in which alternatives to fiat currency, such as gold or Bitcoin, are either excessively taxed or banned. This tendency is consistent with policies intended to maintain individuals' reliance on national currencies, which facilitates deficit management and the use of inflation as an invisible tax by governments in order to enforce negative interest rates. Some central banks have even considered drastic measures, such as banning cash. This strategy would not work if individuals were still able to use actual currency. Now let's get back to the interview.
Central bank reports that have mentioned Bitcoin. So the ECB had a report saying that basically if Bitcoin goes up a lot, then it benefits the holders and it punishes the non-holders or the late adopters. But that's true for any asset. I mean, when U.S. tech stocks added, 10 trillion in market cap over a decade, you want to be owning those. You didn't want to be the one not owning those. Same thing if Bitcoin goes up at size. So it's they argued before that Bitcoin's done as a bad investment, and then now they're shifting it to, if it's a good investment, then that's also bad because it means that those that don't own it are missing out. And that we should maybe curtail that. We should get all the non-Bitcoiners to help us in our politics against Bitcoiners, essentially. Yeah. And then this other paper basically argued that it's easier to run structurally forever government debts when alternatives are banned or heavily taxed or otherwise impaired, which is true. I mean, basically, when after World War II, a lot of the ways that governments solved the debt problem is they kind of just did capital controls, they banned gold, they forced entities and individuals to own debt, and then their purchasing power got partially transferred to the government to pay off the debt. And then the way that they can and this is where using debt strategically can be helpful. One of the sneaky things is that capital gains taxes are not inflation adjusted. So if you buy a house and it goes up by 7% a year, and money supply goes up by 7% per year, and then after 10 years you sell this house as an investment, you don't have to pay it. You might have made no net growth. You didn't really grow relative to the money supply. You just kept up with the money supply, but then now you owe a big chunk of taxes just for kind of keeping up with the money supply. So it's actually similar to by being diluted at the end of the day. And they can do that for gold. They can do that for Bitcoin. They can even target to go after assets higher than normal taxes. if they particularly don't like an asset because it's like the best one or something like that. It's giving them the most headaches. And so governments do tend to want to add frictions or costs or taxes to try to recoup the fact that some people are trying to escape the debasement. They want to impose debasement because they want to tax. They want to spend more than they tax because that's popular. But then when there's obvious costs, or some people are better at escaping that than others, they want to try to then close those like exit doors, or offset those exit doors in various ways. And you see also, emerging markets sometimes do this with dollars. They don't want people owning dollars when they want them to own their own fiat currency, which is debasing even faster. And this is kind of a cycle as old as time, is to try to basically debase the money. It's kind of an invisible inflation tax on the population, and then try to obfuscate or block the exits. And it's funny that the Minneapolis paper just kind of outright mentioned it. It was pretty blunt about it. And there have been other ones, the liquidation of government debt by Carmen Reinhart. It was republished by the IMF, and they're literally just saying that, normally you need a captive audience to own the devaluing debt. And they're just saying it. And then they explored, like, what if we ban cash? Because, if you ban cash, then you could do outright negative interest rates. And the problem is if cash is an option, you can't have like negative 4% interest rates because people would just pull it out in cash. So then they're like, how can we do different schemes to, like, this is back during the disinflationary 2010s. They were just kind of like, hey, if we wanted to have super negative interest rates, how can we make it harder for people to escape to cash, let alone escape to gold or Bitcoin or whatever. And this is where using some strategic debt can be helpful, as long as you don't get over your skis and get liquidated at the wrong time. Because on one hand, you're owning an asset, it's not being debased very much, but you're getting taxed on the inflation. So some of that's kind of still being put on there. But if you're shorting fiat currency, then your spread is pretty big. So if you own a house unlevered, it might not be an amazing investment after taxes and maintenance. But if you own a house with a very low fixed rate mortgage, then that's generally a better investment. And same thing for what MicroStrategy is doing with Bitcoin. They're issuing convertible debt, and it's not like you get liquidated on a Sunday night. It's not that kind of leverage. That's kind of unwise kind of leverage. But it's like leverage that they can't just be called on a given time based on Bitcoin price. And so they structurally benefit from the thesis that Bitcoin will keep appreciating versus dollars.
Lyn Alden clarifies the particular consequences for wealth distribution and the central bank's perceptions of Bitcoin. In the event that Bitcoin's value rises sharply, early adopters will profit while latecomers or non-holders will suffer, according to a recent research from the European Central Bank. Although this pattern applies to any item that sees an increase in value, it is not unique to Bitcoin. The ECB's comment represents a change from its earlier position, in which it minimized the significance of Bitcoin. The emphasis now seems to be more on controlling its effect on non-Bitcoin holders, as though they might need to organize politically against the introduction of Bitcoin. Alden adds that governments generally favor financial systems that prohibit or impose high taxes on alternatives to fiat money, such as gold or Bitcoin. By forcing citizens to rely on national currencies, this strategy helps in their ability to keep control of the economy and enables them to finance debt through inflation. According to her, even if an individual's investments have just kept up with inflation, they may still owe a substantial amount in taxes because capital gains taxes are not adjusted for inflation. By raising the cost of alternative assets through taxes, this strategy gently discourages owning them. In order to enforce negative interest rates more easily, central banks have even considered outlawing currency. People are forced to choose alternatives that progressively deplete their wealth in order to support the goals of government policy if they are unable to withdraw cash. If you found Alden's analysis insightful, make sure to like, subscribe, and hit the bell icon for more content on finance and cryptocurrency. Share your thoughts on government policies and Bitcoin's future in the comments. Thanks for watching, and stay tuned for daily updates.